I'm speaking with Scott Bennett, Director, Factor Strategies and Multi-Asset Investing at Invesco. Scott, welcome to the Inside Network's Investment Leaders Forum, Byron Bay.
Thanks, James. Absolute pleasure to be here.
Great to have you participating, Scott. Small cap investing presents both high return potential, but also the unique risks. How should investors think about the different segments within small caps, such as glamour stocks, fallen angels, zombies?
Yeah, that's right, James. So generally when people think about smaller companies, they think about highly growth-oriented companies that are effectively going to supercharge returns. But what we actually find is when we look at the underlying makeup of these small company indices, they're also littered with a lot of failure as well. So we get the companies that used to be large that are now residing in small cap indices, and they take up a lot of the market cap weight. And these companies, as you pointed out, are really what we call fallen angels. On top of that, we get specifically within smaller companies that are just taking on vast amounts of debt and are much more leveraged, both economically but financially within their businesses. And they can be really challenged in terms of actually generating enough revenue to cover those high interest expenses. And that's what we refer to as zombies. And then finally, one of the biggest challenges for investors within small companies is that companies trade on extremely high valuations with very, very high expectations of future growth. Now, the challenge is most of those companies don't actually live up to those expectations. So that's really something that investors need to be mindful of. And these are often referred to as glamour stocks, as you point out. So for us, we think the best thing for investors to do within small caps is actually just be mindful of avoiding those fallen angels, those zombies and glamour stocks to actually ensure they're getting all of the opportunity and avoiding a lot of the risk.
With active management facing plenty of scrutiny across virtually all asset classes, but particularly in terms of equities within small caps, what are the really crucial factors that differentiate successful active managers in this space from the strugglers?
Yeah, I think the biggest factor driving that, James, is really this component of risk and understanding the risk and biases that are coming through in certain portfolios. So as we talked about zombies, glamours and fallen angels within a portfolio context, one of the biggest biases we see for active managers is actually sector risk. And this brings up huge macroeconomic exposures in portfolios. So when we look across underlying manager returns within specifically small company portfolios, what we see is that there's a high level of sensitivity to things like commodity prices and also interest rates. And what we've seen is that volatility in those portfolios is increased, especially over the last couple of years, as we've seen more macro uncertainty in the market.
Momentum, quality and value factors, they each play fairly distinct roles in small cap investing. How do you think about the interaction of these factors when you're trying to build a resilient small cap portfolio?
Yeah, so let's just define those factors very quickly. So when we think about momentum, what we're looking at here is effectively the growth of the company. So we want to identify those companies that are growing their earnings, that have got good future earnings growth prospects. And when we think about quality, it's really about those companies that have very stable balance sheets, very resilient earnings profiles, and overall good management. And then on the valuation side, it's really about identifying those companies that are trading at an attractive price relative to their perceived value. So those three components are not just relevant for small company investors, they're relevant for mum and dad investors or any small business really. So whether you're buying a milk bar or a mining company or a financial planning practice, there's three things that you want to understand about that business. One, is that business actually growing? Can I trust the balance sheet? Can I trust the earnings statement? And am I paying a reasonable price for it? And the foundations of these three factors in combination is effectively what we see in Warren Buffett style portfolios. So when we think about momentum, quality and value, they're not esoteric, abstract concepts. They're really the foundational pillars of any investment philosophy.
We've talked about fallen angels and many investors are obviously fairly cautious about those because there's plenty of media coverage of them. There's a bit of a pile-on when they start to struggle. But those companies that have dropped from large cap status to small cap territory, how should investors determine that dilemma, whether a fallen angel is a recovery situation and potentially a lucrative climb back to status or just a value trap?
Yeah, it's a really important point. And just to clarify fallen angels and why they appear in small company indices and not large company indices. There's a unique feature with small cap index where companies not only get promoted in, but they actually get relegated in. So the fact that good companies in small cap indices effectively get promoted out, and then as those companies get promoted out, something else gets relegated in, and generally it's a company that's falling. So what we try to look for when we're looking at those fallen angels to determine whether it's a value opportunity or a value trap is really those other factors that I mentioned. So the momentum of the stock and the quality of the stock. So we look at the underlying earnings of that company and what that trajectory is looking like. We look at the sell side analyst recommendations in terms of whether that growth is likely to be falling or growing in time. And if what we find is that a company is a fallen angel and is appearing cheap, but it's got very low growth prospects, it's got a very volatile earnings pattern, then we're very likely to stick away from those types of companies versus something that actually does have very sound growth prospects, does have a resilient balance sheet and resilient earnings. We're more likely to favour those as genuine value opportunities as opposed to those value traps. So there's much more to identifying value opportunities than just the price.
One of the most obvious declarations of fallen angel or zombie is index exclusion or inclusion, and that generally results in commensurate price moves. So is that something that systematic investors have captured and been able to capture constantly?
Yeah, so there is some telegraphing in terms of once a stock either exits a small cap index or enters a small cap index, there's some trading that's effectively around that. And what we see that really builds over time in terms of the momentum. So we like to think, especially for those companies that have just been promoted out of a small cap index, we think that it's valuable for investors to hold on to them for a little bit to get a lot of that positive momentum that's likely to follow. And again, similar with those companies that have effectively been relegated in or fallen angel, you might want to just take some time before actually entering into those companies so that short-term momentum can work its way through the system.
Looking ahead, where do you see the biggest opportunities and risks in Australian small caps, and how should investors position themselves in what is always a challenging and evolving environment, but it seems like 2025 is more so?
Yeah, increasingly markets just seem to be getting more and more volatile, and 2025 has been a testament to that. So we definitely see plenty of opportunity within small cap market and small companies, particularly as I mentioned, there's a lot of economic leverage within those businesses, and also proportionally more financial leverage as well. And as we start to cycle off an interest rate cycle and move towards lower interest rates going forward, that definitely benefits smaller companies. So there's definitely plenty of opportunity. But to your point, we see vast amounts of macro uncertainty, and that's going to be really telling in terms of how you compose those portfolios. So we think that the opportunities across the market are abound, but we do think valuation is really important to pay attention to, and especially the quality of the businesses in this environment. The risks that we're trying to avoid are really being exposed in the short term to some of those macro risks. So we've seen significant moves in commodity prices, significant volatility in terms of trade wars, and also increasing uncertainty around interest rates as well. So by actually avoiding significant sector biases, you can take out a lot of that exposure to commodity risk and interest rate risk, which we think are largely going to dictate the volatility or the risk profile of a lot of small company funds.
Scott Bennett, Director, Factor Investing and Multi-Strategy Solutions at Invesco. Thank you very much for your time.
Pleasure to be here. Thanks again, James.
Pleasure.